All right, this time last week, it looked like the market was about to froth up. If you may recall, that was when my light on crypto went green, and then Bitcoin went nowhere this week. So sorry, coiners, if your favorite no-coiner jinxed it. Still think there's some pretty good trend there, but that was kind of one of the important messages about this week, is that things got a little bit dicey. The red light on bonds has been money. I dropped the green light on bonds to yellow the day of the Fed, Sep 18th. That was the low in yields and the high in price on the notion that 50 bips from the Fed was going to get yields going back up again, combined with the better than expected economic data. So I think it's due time to put the dollar green, because we also found some support on a line that I've had on the dollar for a while. It's one of those things in my chart, I don't even know where it came from, but I haven't missed a ton on the dollar, frankly, in the last couple of years, so I'm going with the line. And what happened this week is we came down, we bounced off it. It's about like 103.8, basically. That served as support after the dollar went up above it, came back down and touched and went up. So as long as the data don't fall apart, the dollar looks to be in a pretty good spot, because the rest of the world's economies are not surprising at the same rate ours is. Our economic surprise index continues to go up. Data this week, again, were impressive. Sentiment hitting 70 was good. We also saw good consistency on new home sales and the jobs market. Everything went pretty smoothly. PMIs were fine. It looks like next week we should be expecting positive surprises on the data, which is why the bond light will remain red and the dollar light green. The slight difference between bonds and the dollar for next week is the possibility that if the earnings go poorly, which I think are still the most important thing right now, given the weight of Mag-7, if they go poorly, bonds could catch a bid if stocks are selling off hard enough. But this week they didn't on Wednesday when tech sold off. So bonds look like they're pretty determined to sell off. It's probably going to take a big drop in tech on earnings, the Mag-7, or super disappointing data, but that doesn't look to be in the cards. So bonds stay with the red light. Mag-7, this was the chart of the week. RSI picking up, that little tail spinning out there. I mean, picking up the pace for momentum in the most important companies and the biggest companies, partially thanks to Tesla squeezing out the shorts, but also Lam Research. We saw Texas Instruments. It looks like AMD's in a pretty good place next week to catch a bid, because this week was about buying up underperforming semiconductors in the last few months, like Western Digital too. So all that augurs pretty well for bulls. Now, of course, the other stuff in the background is that, one, tech is pretty expensive. The chart of Apple's really interesting to me. I think that one could potentially be the most fun to trade right now, because you've got an ascending triangle on Apple, which is something that shows up more in high beta type of trades. There have been a lot of ascending triangles in crypto. There's been a lot of ascending triangles in Tesla. In fact, Tesla's big moves all kind of happen through ascending triangles, but that's the nature of kind of a high beta asset. It suggests positive outcomes more likely than negative ones, but if you have to retrace the slant of that triangle downwards in a disappointment, and Apple's the most expensive ever, I just think it basically says volatility either way. So big moves in tech are probably in store, and so as long as they're not totally destructive to the downside, we should assume that generally bonds continue selling off, and that the dollar probably finds support. Also, if stocks come off too hard, the dollar oftentimes catches a bid, so that's why the green line is on the dollar. Finally, the other development this week was, of course, the persistent selling in bonds and the pinch of the 10s and the 2s spread, that flattening. I thought our guest from Payne and Regal had a good point, which is that bonds in the short term look like they're either going to flatten because the 2 years coming up, because we have to take out those Fed cuts because the economy is surprisingly strong, or you could get the bear steepening where yields just go up and kind of parallel across the curve. So it doesn't seem like there's a lot of scenarios right now that are super great for the bond bulls back to that point, but also it's starting to show up in the regional banks, and that was the other line on the chart there. Regionals don't like the flattener. They got hit again this week, but for the most part, as long as tech is solid, the bond situation shouldn't be an issue beyond the Russell, beyond the regional banks. So I will see you next week. It's going to be a good one. And 2 weeks really ahead of us are why we do this. It's going to be a lot of fun. So thanks for joining us all week. I will see you next week, hopefully. Have a great weekend.